Welcome to Beat the Markets.
I'm Ritger.
And I'm VKM. So Ritger, in one of the prior episodes, we touched on psychology being a critical aspect of this game, the investment or trading game. Why is psychology such an important part of beating the markets or being successful in the markets?
The markets are a psychological game, and I find that we're our own worst enemy in this game.
So what is it about our natural instincts that don't work so well in the game?
I think it comes down to herd behavior. We're looking around us at what other people are doing, and we're evolved to go with the herd. It's just safer. Humans will chastise outcasts, outsiders who don't go with the flow, don't get with the program, or they can be left behind and slaughtered by an enemy tribe, eaten by a lion. I think it goes real deep.
So there's a lot of ways we can go on this, and I could go off what you said, but before we get into that, I want to touch on a few things. And one of the things is when we read Market Wizards or books that are foundational to investing or trading, they get into the psychology, and one of the questions from reading that you think to yourself is, well, what is the right psychology? What is the right mental framework I should have for approaching the markets? Have you thought about what makes for the right personality type, or what is the right psychology that someone should have?
Resilient. Tough and resilient. You know, the markets are they're chaotic. It's a chaotic environment. People lose by trying to guess what they're going to do, but in a chaotic system, anything can happen, especially over the short term. It's very hard to predict with any statistical significance which way prices are going to head. I mean, we use things like value, like momentum, to tilt the odds in our favor, but
that's over time.
Over time, when iterated over and over, 52% odds are pretty good over. If you play enough hands, those are good odds. So that's actually, they call factors tilts. Little advantages like this can be called tilts. And so I think the right approach is to be humble. You have to recognize that you're not going to win every time. A lot of the greatest traders out there lose most of their hands. They'll lose 60-70% of their hands, but they're just small losses. So you have to be humble and admit that you're wrong quickly and take that loss.
Right. So this is a whole box of exploration. So one of the things that I got a long time ago was one of Soros's quotes, which was great, gets to your point of that you don't need to be right. It's not right. We're not in school. We're not trying to get 90% plus to get an A. It's what Soros said, which is that it doesn't matter how much you're right or how much you're wrong. It's how much you make when you're right and how much you lose when you're wrong. And so that's why you can be right only 30% of the time. But if your winners are bigger than your losers, you can be successful in the game. Getting back to the right psychology, you ask 100 traders or investors, you'll probably get a variety of responses. If you'd ask me, I think it's two in addition to resiliency. One is independence of thought, and that gets into this idea that, and maybe my two attributes are the one and the same, which is independence of thought and not being swayed by the emotion of the time or the mood of the time. And maybe that feeds into the psychology, like you're saying, we're wired to go with the herd. And so what happens maybe is that when something is very popular, there's this, I don't know what it is, but this group instinct to everybody want to participate in it. And we have to as an individual, make our decisions based on something different.
There's a flip side to that, though. It's actually easy for some people, contrarian types, to be stubborn, too stubborn. You only really make money by going with the herd.
So so that's where, when I said we could go a lot of different ways, that's what I was going to get to, is that if you say that we're wired for the herd, then that seems like it would lend itself well for like a trend following system. But the average person doesn't do well with the markets, right? So we're wired to go with the herd. There are systems in place that do well with herding, such as trend following, which lets your winners ride.
They see the herd start to move, they jump on. If the herd switches and goes the other way, they get right out. But they'll always just jump on the herd. If there's a herd forming, they'll jump on it, try it out, see if it goes somewhere. And most of the time it won't. They'll take a little loss, but sometimes, well, you leave your upside, you let your winners run. So,
right, and I'm a big fan of that system. I think from a larger perspective, it's a very powerful system, because ahead of time, it's a humble system. You don't know what's going to turn into something. You don't know. So there's two ways. There's I think two big ways to approach the market. One is your humble system that you know nothing, and then the other one's a very, an arrogant system where you know everything. You crunch the numbers. This is what it says, and therefore this is what I do.
Yeah, that's technical trading versus fundamental trading. Momentum versus value.
Right. Exactly. That would be. Momentum and technical would be in the humble system, and fundamentals and value would be more in the let's maybe not call it arrogant, but the idea
Stubborn.
that or the idea that you know something.
Yeah.
You're knowledgeable.
You're predicting the future. A stock is in the doldrums, but the business looks good. It's trading at low multiples. Well, you know that a stock like that is likely to outperform. So you're in it, even though it's not doing anything. You think it's going to move.
So let's pull it back a little bit, back to the psychology aspect of it. So if we're wired to go with the herd, and when we have this flight or fight instinct in us, what is it about those traits though that don't translate well when it comes to markets? Like the average person, unless I don't want to say change their personality, but they have to do something to their natural intuition to be successful in the market. The natural intuition, I don't think, lends itself to be successful in markets.
No, it doesn't. Kahneman and Tversky have identified all these cognitive biases, like loss aversion. People, it's more painful to take a loss than it should be, even a small loss. So people avoid doing that. I wish I could rattle them off, but there are a lot of little cognitive biases that work work to our detriment.
So this is probably going to advance a little bit quicker than I was thinking, but how does one overcome those biases?
That's what quantitative trading can do. That's what having either you've internalized your rules, like Buffett and Munger have. They know what a good company looks like. They know what a good price looks like, and they have such conviction in themselves. It's just second nature to them. They won't overpay. They won't buy a crappy business. So they've internalized their rules, but their rules are actually pretty simple. A trader, I always think back to the pit traders. If you look at videos from Chicago in the 80s or 90s, and you see these guys, they were not professorial eggheads. These were just tough guys.
Well, actually, the pit, it helped to be a big guy,
Yeah.
so people could see what you want to do.
Yeah, I don't think they weren't playing 4D chess. They're just running simple little algorithms. Market's moving on long, turns, I'm out. Don't go short. Don't, watch your size, don't go too big. And little algorithms like that are developed through iterative processes. Evolution. A smart guy will look around, they'll listen to the old timers, they'll look around, they'll see somebody do something and go bust doing it, they're going to avoid that. and they'll learn from their own mistakes. They'll go bust themselves. A lot of guys start out going bust over and over. They'll get a little stake. They'll rent a seat on the exchange. You read these stories from the 70s. Somebody has a $10,000 stake. He saved up a couple of trades and it's all gone. Well, lesson learned. Go back to work for 6 months and try again. And so I think it's an iterative process that creates these survivor algorithms. These algorithms that they're really simple. They're just robust. I think that's what it takes, because the markets are chaotic, they're evolving, they can't really be predicted. The kinds of patterns you find, and they are pattern, they're not random. The chaos is different from randomness, but the kinds of patterns are always changing. Correlations are shifting. You go from bull market to bear market to sideways market. But the algorithms that win are the simple ones. They're like cockroaches. They just persist through whatever comes. And I think to persist, it has to be simple. It has to be just a few simple rules. If you get too nuanced, then you're just, you try to, this is like Nassim Taleb, right? You try to eliminate every loss by creating this perfect model that just chugs along so smoothly. But it's adapted for that particular environment, and the environment changes, and then it goes bust. So I think it's got to be simplicity with a focus on downside, because it's really all about survival.
Right. Well, now you're getting into like what makes for a good algorithm.
Yeah.
Let's take a step back into what you said, that Buffett and Munger have internalized their algorithms, and then what's popular, and I don't want to say popular to say that it's just like a fad, but what's come up in recent time relative to other methods of investing. Quant investing is pretty hot right now, and in terms of the amount of money that's being allocated to it, and it seems to have come to the forefront to some degree in recent times. I guess what do you think, I guess, drove it to the forefront in recent times?
It's hard to beat.
I mean, is it just maybe the superiority of it versus other methods?
I think it's a Darwinian process, right? Active prop traders, non-systematic traders, guys who are trading on predictions and theories and their own internalized systems that aren't rigorously tested and executed according to numbers. These guys they can be real hot for a while, but they tend to flame out. And few of them, I mean, they just don't do as well.
Well, one thing I just realized, when we were coming up, meaning in the 90s and early 2000s, we didn't have the average person didn't have the access to doing a lot of the quant studies that we can do now, even just like you and me.
Yeah.
And that's a function of computing power becoming much cheaper. So meaning that's why we can do the quant studies right now that we couldn't do before. So we kind of, when we were coming up, did what all traders did before that, which is you read some books, you participated in the market, you did this iterative process, you tried to make sure you didn't get burned too bad, and what Livermore, or what Remnants as a stock operator says, you learn and you earn. But in recent times, and maybe it's the culmination of a few things that came together. Maybe it's computing power becoming cheaper, a lot of the data becoming more ubiquitously available, and then the 2008 crisis exposed a lot of flaws in maybe other methodologies, and showed the robustness of this methodology. Or maybe there's a few things come together, but when we started going down this road of quant investing, I saw how much of a superior system it was to anything I was doing before. And I'll get into a few aspects of why I think it's more robust than other systems. But even when you're getting to something like even if it's more superior than internalizing it yourself, because this is the problem with the investment game, is you can internalize and figure out things figure things out, internalize it, and then play with it, play that road for 20, 25 years,
Yeah.
and then you have a slip up, or you have hubris, or you think this time is a little bit different, or you get bored and you go down this other road, and you can lose a lifetime's of work like that. And that's what I like about systematic investing, is that it keeps you true to your methodology.
Absolutely. It doesn't have bad days.
And that's
It
another
doesn't
thing.
get Alzheimer's. It doesn't get divorced.
Doesn't have a hangover.
Yeah.
I mean, you can wake up and be in a great mood, and you can be more aggressive in the market that day, and or you could wake up and feel crummy and be more defeatist or not than you ought to be, and that has nothing to do with.
Not to mention that it's probably a better system to begin with, because the way humans learn is full of biases. We learn lessons that we shouldn't learn. We miss a lot of lessons we should learn, whereas a good system developer will use a rigorous statistical process and gobs of data, historical data going way back in all different markets all around the world. I mean, orders of magnitude more than any human being could absorb. And then it will be analyzed using numbers. I mean, it'll get crunched. It's not just the impression; it's the actual data. And a lot of systems are counterintuitive. Good trading has always been counterintuitive, but it really shows up when you crunch the numbers.
So that's not hard for people to believe in today's world, that a lot of data is superior to just winging it.
Oh yeah, the more data you've exposed the system to, the better you can confirm that it's robust. The risk is when you try to make it too good. So you really need to focus on more and more on survival. You want to make sure that it's done okay during every 5 or 10 year period in all of these different markets. You don't want it to be off the charts in some and a bust in others. And you want to see that it behaves similarly in all these markets, has a similar profile. The returns are not that different. The downside is not that different. You're just boiling it down to simple rules, and you're looking for a survivor. You want a cockroach.
And the other thing about it is, if you're able to find thing that works in multiple regimes or multiple countries, or there's some universality to it.
Yeah.
Therefore, it should keep working in the
Yeah, because we don't know what the future is going to be. The market changes continually.
There should be also some internal belief in the system that it can't just be that you did these studies and these numbers worked out.
That I would be suspicious of. This goes to the problem of where do humans come in? Is there still a role for humans? Okay, yeah, obviously humans have to write the programs. We have to do the analysis, or at least create the programs that do the analysis. But I think there is still a role for humans in occasionally. And we can discuss when a system might be overridden, what kinds of systems you might want to override them, and what signals you would use to override them, and then whether those signals should be integrated into the system itself. But there's also, going back to your point, you want to make sure that a system uses rules that, with a little bit of thought, make sense. I mean, maybe it's counterintuitive at first to say that you shouldn't be afraid of a system that has 70% of its trades as losers.
But living with it's a hard thing.
Living with it's a hard thing, but what I'm saying is that seems counterintuitive at first, but then you think about it.
Oh, I see what you're saying.
And
you see how it works.
And that's a basic. Okay, that's a rule that all traders have always, discovered. You take your losses.
So, I mean, I'll tell you why the importance of having it rooted in something that you can buy, that you can mentally buy. So, I mean, it's a flippant quote, but
sticking with it.
Sticking with it, but the flippant quote is that the worst 10 years of a strategy is the 10 years that's about to come.
Or the worst drawdown of any strategy, by definition, is ahead of it.
Because you would have chosen.
Even if you tested it over 100 years, well, there's a lot more than 100 years ahead of us.
Right. So Jack Bogle that came up with the methodology for Vanguard, which is just essentially buying the market and because most active investors don't outperform the market, so just buy the market as cheaply as you possibly can.
Bogle mentions valuation. He says buy the market cheaply.
No, I'm sorry. I misspoke. Meaning buy the market as cheaply.
You mean with the lowest fees you can
lowest
find.
fees you can, as lowest fees you can get, because most active managers don't beat the market, and he based that off his study. What was funny was when he started Vanguard, the next 5 years, like 2/3 of active managers beat the basic benchmarks. So in order to continue, he had to truly believe that his study had merit.
Yeah. And
he did, and time bared that out that his studies did work. And so that's the idea, that it's got to be rooted in something. Meaning, if you did some study where all stocks with A's outperform all other stocks, you're going to go through a rough patch, and then you're not going to believe your system anymore.
Yeah. Or you could. I mean, maybe it's always a great year after the Yankees win the World Series, something like that.
The Super Bowl indicator they got, right.
You can find, you search the world for correlations, you can find them.
Right. But you won't be able to sit with them. And that gets into, so boiling it down a little bit, the world of quant investing or systematic investing eliminates a lot of the human biases. And that has a tendency to do very well in the markets. We can get into why human nature is not why our natural human nature is not optimal for the markets, but we know it's suboptimal because you don't want to be making your decisions haphazardly or just by the circumstances of the situation you're in. It should be driven by something else, and that can be coded ahead of time.
We know that the vast majority of people who attempt to just outsmart the markets lose money. They don't just underperform; they lose money. I mean, that's all we need to know.
Right, and so you can develop a set of rules that you can statistically test that outperforms the market. Then you only need to have one key attribute, which is to stick with the system.
Do what the system says. Follow the rules.
That's really, that would be the only psychological attribute you need at that point, I think. Confidence and discipline, and to believe. Confidence to believe in your system, and discipline to stick with it, which really boils down all the personality types you can have to be successful in the markets. But you have to come up with a set of rules. Should we spend a little bit of time talking? You spent some time in terms of talking about you want a cockroach of algorithms, or something that's resilient or robust in all markets. I think it's worth.
It doesn't mean it won't have any volatility. Value investing is robust. Over the long term, it'll survive. Value companies can crash like the rest of the stock market, but because they're solid companies, value and quality,
right?
You know that you own these enterprises.
And I'd say a bear market doesn't take it out of business.
Doesn't take it out of business.
So that's my theory on value investing, is that you're buying quality, and this cycle's happening behind you.
You ride it out, you earn it out. A good business is going to churn off cash flow even in a recession.
And then when that bull market comes, or the cycle turns, then you get.
You've got to have a real long-term frame of mind when doing value investing.
Right. So um, I lost my train of thought, but where were we with the
Sticking with it, sticking with the system. So let's back up for a sec. We can mention how people have found algorithms in other fields that have outperformed professionals. Medical diagnostics, autopilots.
Let's talk about autopilot. I mean, so I don't know the full story. Like, I didn't follow it, but there was some pilot that was a big hero because he landed the
Sullenberger in the Hudson.
Yeah. So why did he need to override his piloting system?
He lost power. I don't know if it worked when he was. I don't know if the autopilot was programmed to land on water, and he had to make a decision.
Why did he need to land on water?
He'd taken off from LaGuardia, I think. He headed north and hit some geese, lost power.
Oh, right.
He did the figuring in his head. He looked at where he was, his speed, his elevation, and figured it was too risky, or he wouldn't be able to execute that turn and get back to LaGuardia.
So that scenario is this, creates this.
It's outside of the test environment. Okay, I'm sure that an autopilot system is designed to handle gusts of wind and I don't know, a pilot having a heart attack. But loss of power, too far from an airport, it's outside the bounds. So any model is going to be limited by what you've fed it in the past, and you can't feed it the entire universe
because you don't know
all the potential. They're either unknown unknowns.
Unknown unknowns. People made fun of Rumsfeld when he first came out with that, but it's true. There's so many unknowns.
It's his greatest contribution to civilization.
It might be. So bring it to the world of investing. I think there's a large swath of people that are uncomfortable with algorithms or machine running investments, and one is it doesn't lend itself to the great story. But aside from that, is this fear that the machine is going to be proven incompetent at some point.
Because machines will occasionally do things that are just patently stupid, obviously stupid. They occasionally do something that's really stupid. You just want to make sure that those little errors are contained. But we see a machine do something obviously stupid, and we think, oh, dumb machine, you can't trust this thing. But we're ignoring. We have to consider that humans do things that are not so obviously stupid all the time, not just occasionally.
It's the devil you know versus the devil you don't. But
exactly.
Maybe we can't escape the stupidity. We're more comfortable with human stupidity than machine stupidity.
We see this with self-driving cars. I think the Google car went 300,000 miles before it got into a fender bender, and I'm not sure it was the car's fault. But we demand a much higher standard from machines. I think that's just anything new and unfamiliar, we hold to a high standard.
That makes sense at a.
It's like a built-in precautionary principle.
Yeah, like why move to a new paradigm until it's proven robust?
Yeah, I mean that's a good algorithm. We have a lot of good algorithms built in here too.
Right. So that's the a key attribute, I think, for making a good algorithm. Not to get too specific, but when we design an algorithm or think about algorithms, we get caught up in the signal in terms of what we should buy. But this to me, when I realized how many discretionary or discretionary therefore are potentially arbitrary decisions we can make, it gets exposed when you think of developing a whole investment system, because you have the signal. You also need to have risk management, and that gets into what makes it robust and a cockroach. If that risk management is strong, then it really can survive any market. And position sizing. So meaning we can have an algorithm So we say Buffett's internalized an algorithm of what companies to buy, but then you also have to internalize or come up with an algorithm of how much of your portfolio it should make.
Yeah, you don't want to be making each of these decisions ad hoc every time.
And there's so many decisions you make ad hoc, or you say, or you kind of think you kind of intuitively are doing it, or you've done it for so many long that it's just habit and practice. But the danger in that is that you can say, oh my God, this is the greatest company I've seen, and you know what, it deserves twice or three times or my normal allocation, which is what what you've seen sometimes. Well, I can't avoid the name in this one, but Bill Ackman did with Target. I don't know why, or if it was just a marketing ploy, but he put all his investors in Target, and it didn't really work out in that fund that he raised for that particular secret investment. That's how he pitched it. I got a great secret investment, and so the point being is that position sizing is an aspect of portfolio management. When to get in, when to get out, when to get in if it's doing well, when to get in when it's doing right. Mm-hmm. And when you sit down and make the rules, you realize how many discretionary decisions there are on top of just security selection.
Mm-hmm. Yeah, you don't know when to be making them. You're going to be, when do you stop? When do you get in? When do you get out? Every day you come to work, the trading starts. People look for things to do, and they should just sit still.
And you get a new client. So, okay, I have all my ducks in a row right now, and I am very excited about my securities. I'm excited about my position sizing. I'm just excited about my risk management. And I raise a big fund, and everybody gives me money right away. And we start along that process. But then you get new investors. What are you supposed to do with them? It's a whole. Their decisions. The decisions you started off with aren't the same thing that are 6 months later. So this all lends itself to why a set of rules is so much more powerful than just a collection of even good judgment.
Yeah, I agree. Something occurred to me when you brought up Ackman and Target. This is something else that I think distorts our performance in the markets. In the private sector, in any sphere outside of the market, especially in business, confidence in yourself is a good thing. The power of the will and discipline create value. You have a great idea for a company. Sure, there's an iterative process there. Most companies go bust, but maybe Target is a languishing company, and Bill Ackman isn't a hedge fund manager. He's a buyout guy or a CEO. He's a manager, and he comes in and he whips them into shape. In the real world, will and confidence and intelligence count for a lot more.
They go a long way, but for some reason those qualities don't translate into markets.
No, everybody's humbled.
IQ doesn't translate to markets.
Above a certain threshold, no.
And I would say too high IQ is the worst for markets, because you've conditioned, or you think you're smarter than everybody, you're smarter than markets.
You get creative, you get ideas, and you have too much confidence.
And so in terms of this is what I think is interesting. You need confidence to sell. It's an important attribute.
Yeah.
You need to get investors to buy into you. You need to get your employees to buy into you. But to be successful in markets, I think humility is a huge.
Yeah. Above a certain threshold, humility is more valuable than intelligence.
But it doesn't lend itself well for humility. Doesn't lend itself well for.
No, that's why you need salesmen.
And that's another algorithm Wall Street figured out. Wall Street figured out you got to divide the sales and traders, because the traders can't sell. If I guess the stereotype was that they're a little rough around the edges.
But any trader speaking the truth to clients who aren't familiar with trading or the markets is going to scare them off.
Right.
There's so much that's counterintuitive.
Right. if their trades are going against them that day, then they might not be in the best mood.
Yeah.
But the salesman's got to always be. That's what he's paid for all, or he or she is always in a good mood. So that's an algorithm that Wall Street figured out, and so that gets into, I guess, when we're figuring out when you approach the markets, and so much stuff is counterintuitive. How do you know what's worth taking as fact or been proven, such as the trend is your friend, versus some other attribute that's just a false belief?
That's where the algo comes in.
So the idea being that you have a bunch of hypotheses. So we have the hypothesis that the trend is your friend, and then the other one, which is a quote that people love, but most traders would say that doesn't work, is that you never go broke taking a profit.
Oh yeah, that one is just dead wrong.
That one's dead wrong, but it's a cliche or saying that Bernard, that's attributed to Bernard Baruch, and people repeat it, but the data will prove. So that's what you do. You take these hypotheses, or start with some. These hypotheses are collected into like a single line, but you have it. Whatever, you may have a more complex hypothesis, and then you test them. And the data will bear out what's successful. So then this gets into so where's the role of humans? Not everybody is. Not everybody. First of all, before we even get into where the line between machines and humans, let's start. The line between humans is there this world of investing that's bifurcating between the ones that can tabulate and manage the data versus versus the unwashed that can't.
I think that's what's happening. The guys who can distill and run algos are going to end up with all the capital. Even if that algo is simply an S&P index fund, that's still an algo. Factor investing is algo investing. Anything but making one-off decisions, using your intuition, getting ideas is an algo. Some are more complex than others, but every kind of algo is just taking. You can see. I saw this chart today. It was okay. Over the last several years, here's the amount of inflows into algorithmic investing, passive algo investing, and inflows from active investing, and they mirror one another. And capital is just fleeing active investing, as it should, because active algos can be active. Anything worth doing, can be coded. I mean, what are you doing? What is your mission? What is your fund's mission? What is your strategy? Well, if you can articulate it, you can code it.
Right. Or you should be able to, and if you can't, then it's a little too loosey-goosey.
You got to tie it up.
You got to tie it up.
Yeah.
So this is a whole line of discussion to go down, but the activists will say, well, this is going to create inefficiencies for the market for the securities that they get overlooked.
I don't think so, because these algos are active. Sure, they're rules-based, and they're exploiting factors, so maybe we're not calling them alpha anymore. As soon as something is proven to work, as soon as you can distill something down to an algo and prove that the algo works, the academics don't call it outperformance or alpha anymore, and they don't give the managers any credit, but they really should, because it's still coming from humans. I mean, humans they're not testing whether the market goes up when the Yankees win the World Series. They're testing, hypotheses that have some, reasonable basis for working. There are algos that read the Federal Reserve's press releases. They read company press releases. The instant they come out, they scan for keywords, phrases, and they buy and sell. That was an opening for humans, right? So imagine a value fund that it's looking at, projected revenues. Say a company gets a new contract, the projected revenues double. Totally changes, or a biotech gets approval for a drug, totally changes the profile of the company, but it's not in the financial statements yet. And the number crunching value algo needs audited, filed financial statements. Well, the human would see the press release and say, "Oh, this is an opportunity. This is something that we're not picking up on." But now algos are stepping in there.
With the I guess this borders into artificial intelligence and I guess algos or computers being able
even
to
those are just going to they're going to be statistic. I mean, they are going to be, they're going to search for certain keywords that have been associated with negative press releases, and others that have been associated with positive.
Right, absolutely.
It's going to be a statistical process. It's going to be the same. It's not going to be perfect, but it's going to be the same thing, a statistical process.
And it is superior. So
Yeah.
then.
And also, they'll look at how stocks have reacted after each kind of press release.
And it becomes
Because sometimes you sell the news.
it becomes self-learning.
Yeah. Yeah.
So then what is the role for humans in the future of money management?
It's coming up with ideas for algos and testing them, training them, and convincing other humans, teaching other humans how the markets work, and helping them make plans, keeping them out of trouble. It's interfacing between the algos and the humans.
So I'll tell you that when we started working, we got our first job on Wall Street. We were interviewing at a company, and I interviewed. My friend was interviewing, and my friend came from a modest background, and he said to who was going to be our boss, but it was during the interview, was that, I just want to say, thank you. I think it's great that you guys are hiring guys like me and giving us access to the markets. I used to think stocks was only for rich people. And the guy interviewed goes, stocks only are for rich people. And where I'm going with this is that, maybe I think this systematic investing is a great thing. But maybe systematic investing is only going to be for rich people, because this is the way money should be managed statistically, large amounts of money. The trade-off is that the young person, the ambitious person, isn't going to get rich overnight using these systematic means. So I could see it becoming bifurcated, right? Algos and systematic investing becomes the domain of that.
Well, the fresh blood feeds the algos.
The fresh blood feed the algo. That's the sucker that's born every minute.
It's a zero-sum game. Sure, the existence of the markets helps transfer capital allocated efficiently, and helps humans do their thing.
And there has to be a place for the young, ambitious person to. I mean, I don't know if that goes away, right? I mean, the young, ambitious person has to have.
It's still that myth, the myth of the trader, the allure of the quick buck, is still alive and well, and we see it among, guys college age and just out of college. They're going through what every generation before has gone through.
They seem to be applying it to the cryptocurrencies.
Yeah. But what you have to understand is that it is a zero-sum game. At the end of every trading day, some account balances are higher and some are lower, and it evens out.
That's alpha. Alpha is a zero-sum game.
But even beta, even factor investing.
And factor investing, smart, right? Anything other than market beta is a zero-sum game.
Yeah. Even market beta. If you're defining market beta as a certain index, as the S&P. The S&P is an algo that beats the majority of people who try to do something else. The S&P is taking alpha from active investors.
That's an interesting
We're
way to look at it.
underperforming it, losing money.
It's interesting. I never.
Yeah,
thought of it
S&P
that
has a
way.
lot of alpha on active. It's like 6% a year.
Huh. That's an interesting way to look at it. So, our show's kind of catering to the average guy or the average person. So, if we talked about psychology, getting the right psychology, a lot of people can I guess work on the individual at home could work on that. But how does our viewer begin going down the road of putting together algos? How accessible is that to your average person?
So an average person should not attempt to put together algos. They should just find a good manager, identify good ETFs if you want to do factor investing, or you could do a really simple algo yourself. There are algos that you can do yourself, like 50% stocks, 50% treasury bonds. Every year you rebalance. It's an algo. You'll beat all your neighbors. You will. Over the long run, you'll win. You'll do great. It's volatile. It's not optimal. Yeah, you can do better. But should the average guy try to do better? Probably not, unless he's really into this. He has that minimum of IQ. He has the inclination to devote some time to it. And he really needs to devote time. People know a lot about the markets. This is something that even you and I, after many years in the markets, as independent traders, we were still humbled when we really buckled down and started reading books and papers. There is a lot of good work out there. There's a lot of knowledge, a lot of wisdom. And you don't have to reinvent the wheel. So give yourself an education.
I think you touched on a very important point, which is that there's a lot of cheap, available, accessible, smart algos out there.
Yeah.
For your average person to approach.
Yeah.
If a person wants to go down the road of how we went down as the independent trader, then you have to be prepared to go through a lot of.
I wouldn't recommend it. I wouldn't recommend it because what are you going to learn? You're going to learn the same lessons that you can read in books. Right? We all learn the same lessons.
I mean, I agree with you. It's very difficult to dissuade the young, ambitious person.
If you need convincing, just do it with a small amount of capital. Don't mess up your life. Keep it small. And just remember that the number one rule that you're going to take away from this process, if you stick to it long enough and you survive, and you're one of the few who survive it, the rule you're going to take away at the end of the day is to watch your downside, control your losses. That's it.
That's the biggest thing you can do, and that gets maybe into what we'll do in the next set of videos is how to control the downside, how to risk manage.
Yeah.
But that might be a good point to leave it off.
Okay.
So thanks for watching, and hope to see you next week.
Please like and subscribe.